All right, so the S&P released its August U.S. manufacturing PMI. And I got to tell you, it's really impressive, folks. Highlights from them, they say stronger output, growth is linked to higher sales, inventory building. They did mention tariffs, that they were up again and with respect to output charges, but also employment up. And they use the word markedly as confidence improves. The chief business economist over at the S&P Global actually gushed about the strongest manufacturing expansion since the first half of 2022. The question is, how will this report and all the others out this week influence the Federal Reserve? And of course, what does it mean for the stock market? I want to bring it out JP Morgan Asset Management Global Market Strategist Jack Manley. Jack, that's one hell of a title, my man.
And you got through it, too. Thank you.
If it was any longer, the show would be over. We've been handing off the list. So, you wrote this. You wrote a report, I think, on the 18th, 13th, 18th, and there was a line in there that I thought was so interesting. While the Fed will likely succumb to cutting pressure in September, investors should realize that the trajectory for interest rates may not be as aggressively dovish as recent data suggests. But succumb, it was like they were in a full Nelson. Do they even want to do it in September? Or you're saying they just caved into pressure?
So I sort of struggle when it comes to my view on the Fed right now. Powell has made it very, very clear, both in writing and in speech, that he believes that the overnight rate right now is in restrictive territory. That, to me, makes no sense, right? You got an economy that's showing a lot of different things underneath the surface, good payrolls, then not so good payrolls, negative GDP, then very strong GDP. I don't think it makes sense right now for rates to be in restrictive territory. Why not keep it into neutral, kick it into reverse if you have to, kick it into gear if you have to, right? That, I think, justifies the beginning, or the re-beginning, I guess, of the cutting cycle. The reason I'm not so convinced the Fed's going to do a whole lot more than that is that underneath the surface, I think there are still a lot of data that are really supportive of a fundamentally strong U.S. economy. I mean, we do see a little bit of upward pressure on inflation. Of course, that's going to challenge the Fed's narrative. You look at what's going on in the labor market, and the unemployment rate's tight, wage growth is strong. That's a sign of underlying strength. And when we think about the economy, the consumer is doing pretty well, Charles. So,
but that's the aggregate data, right? So the CEO of McDonald's today said that the upper income folks earning $100,000, they're doing good. The stock market's up. They feel really good and confident. He says the middle and lower income consumers it's a different story. A lot of pressure. Traffic for lower income consumers is down double digits. And that's because people are either choosing to skip a meal. I mean, think about this. People are skipping breakfast or lunch. And so this is where I have a problem with economists in general. It's like this aggregate data, I think, is missing the point. Those who are doing well are doing extraordinarily well, but I think it's skewing the overall number.
I don't disagree with you, Charles, but here's kind of the dirty secret when it comes to looking at these numbers. The data very clearly tell you that those people that are doing well, that are doing extremely well right now, they're the ones that move the needle from an economic perspective. The top 20% of earners in this country, which means about 100 grand
they're the
or
ones
more,
who sort of count. But Fed actions, though, impact everyone.
They do indeed. And where you are right now, I mean, you have, to your point, it's tough not having a lot of money right now with where prices are, with where wages have been, with how people are locked out of things like the housing market because of where mortgage rates are. I do think there is plenty of evidence out there, plenty of arguments to suggest easing rates. I just think the Fed's going to want to be more cautious.
Well, also, we've got a lot of labor data out this week. So we've got JOLTS, jobless claims, ADP, Bureau of Labor Statistics. Outside of BLS, which one of those should we be focused on the most?
I always like jobless claims because they're the closest thing that you get to real-time data for basically anything. So,
would you be more focused on initial claims or continuing claims?
Continuing claims is, I think, always where the interest is, right? Because what we see is, if you get laid off, how easy is it to find another job? And if you see continued claims pick up, it's stagnation in the labor market.
That's where I feel like the crisis is. It's like getting rehired, right? It's not laying people off, because companies are loath to lay anyone off, particularly if they're well trained. But if you lose your job in this environment, let's shift to the market for a moment, because these the story is always like the Mag 7, how they're up to 40% of the market.
Yeah.
But they continue to have this earnings growth that's amazing as we wait for the 493 to kick in.
You cannot ignore the resilience in the earnings story for that Meg 7, Charles. I mean, that is absolutely true. They're not going anywhere right now. And I think that all these kind kind of factors underneath the surface are driving a really interesting dynamic from a participation perspective when it comes to like what companies are doing well, what companies aren't doing so well in the S&P 500. Last year, the year before it, 2 awesome years for the U.S. stock market, right? 20+% returns. The Mag 7, 60% of those returns in both of those years. Right. This year, we started off with a real honest-to-goodness broadening out story where the Mag 7 was only like 20% of those returns. A couple weeks ago, it had shifted all the way up to like 50%. Now it's closer to 40%. We're seeing this participation story kind of ebb and flow in response to investor confidence, you know, what's going on right now with the Fed, with rates, with data. Right. But I think the long-term story is still very interesting where we're looking at something close to earnings growth parity almost between the Mag 7 and everybody else out in 2026. So for me, that rotation story is not so much an if, but a when, and the when's just a little bit further.
All right, Jack, we'll leave it right there.